A big thank you to all of my listeners. And if you would like to support this transmission even more and boost your trading account, go to trendfollowing.com/now. And without any further delay, on to today's show. This is Trend Following Radio, where great thinking comes alive. Nobel Prize winners, legendary traders, best-selling authors, and the pros that know what drive us irrational human beings. I am your host, Michael Covel. Not filtered, raw, honest. That's my passion. My guest today is Ted Parkhill. He is the Chief Executive Officer of Incline Investment Management. Ted is all about systematic, disciplined diversification. A trend-following perspective for sure. And for those of you out there that sometimes say, I don't have enough trend-following guests, Ted brings a really interesting story. Going back several decades, I think you're going to find his insights, his perspective are quite grounding. Plus, he has the benefit of having a great story about his introduction into the world of trend following. Learning from working with one of the legends, the all-time legends in the fund management space. I hope you enjoy this conversation with Ted Parkhill. Ted, take me back to some early stages. So right now, you're a fund manager, but you didn't start as a fund manager. So I want to know, where did this market fascination, where did this start for you? What age? Give me an early experience. I don't know, teens, 20s? What was the transition for you? Or did you always imagine this when you were a 16-year-old kid?
That's a great place to start, Michael. I appreciate that because indeed it goes back that far. My background is I have two brothers and my father was a broker. Of the three of us, I have an older sister too, but I was the one that was interested in the markets. Our dinner table conversation revolved around what was going on in the world, both from a business standpoint and a political standpoint. So it was anything political or business-wise was fair game. There were some subjects that perhaps we were somewhat of a traditional family we didn't talk about. But I had the opportunity to really be exposed to markets and trading. I grew up in a city where there was a commodity exchange, and I knew a number of people that were involved, and I had an early interest. In some ways, I might be have considered myself a bit of an Alex P. Keaton, to sort of reference a modern sort of era family ties reference there.
Go back in time, though. What city and what were some of these influences exactly hitting you that early?
I'm originally from Winnipeg. And it's an agricultural town where we have the Winnipeg Commodity Exchange. I'm Canadian and grew up in an environment where people knew what was going on in the markets. And I guess because of that influence, I sort of, for my 18th birthday, I was given stock from a number of my parents' friends because they knew that was my interest. And believe it or not, back in those days, you kept track in a notebook of what you held. And so I kept that notebook for years of the stocks that I held. And so through university, I ended up studying economics because I was fascinated with how things, money and banking and how things worked in a more macro level. And I ended up, with my dad's encouragement and sort of as a mentor, I traded oil options while I was still in school and ended up paying for a year of my university. Well, that may sound impressive today with university rates where they are. My university was a lot cheaper back in those days, but it was sort of my opening to a world that was pretty fascinating for me. And had I known, I guess in some ways, I probably should have, and if I have a regret, I would have loved to have known about the floor trading in Chicago, because that's a place I probably would have gravitated to had I known.
What year would this have been roughly, Ted?
1985.
So right in the heyday of Chicago time, right in the heyday of Richard Dennis and whatnot.
Absolutely. And you know what? Growing up in Winnipeg, I didn't know a lot of what existed. And I guess in those days, if you thought of financial markets, you moved to Toronto, you didn't move to Chicago. And so I And ironically, may sound funny, but I grew up on Harvard Avenue. And so at a very young age, I had sort of aspired to going to a really good school. My grandmother lived on Oxford Street. The next street over was Yale and Cambridge. My paper route was on Cambridge. And I always sort of aspired to going to a really good school. Kid growing up in Winnipeg that was a lofty goal. Eventually, I made my way to business school at Cornell in Ithaca and really, thought that was a fantastic environment. I guess at a young age, knew that I would end up in business in some way, shape, or form. When I graduated from university, I ended up as an investment analyst. That was my start, actually, in the portfolio world. That doesn't come across. I don't talk about these days so much anymore, but that was where I started. What became very clear to me was, the guys that did really well could explain what they were doing. And a lot of these portfolio guys were too sort of intellectual for their own good in a way. And I remember one of the portfolio managers I worked with way back when, he had an English degree and a master's degree in geography. And he did a fantastic job of explaining, why he was buying certain things. And I was fascinated with that. I also worked for an early, what I would call a chartist. He was sort of before his time in a way. And it goes back to the early 80s. And at that time, as you well know, some of the, early CTAs were just getting started. And back then it was paper and pencil. It was almost pre-Excel. What was
his charting? What was he doing? What were you learning from him? What were you getting exposed to?
He was looking for patterns. And I thought that was just made a lot of sense. I thought that was really sort of, practical and quite prudent, in fact, to look at history and history does repeat itself. And so, I looked at all these guys doing all their research and the fundamentals. And at the end of the day, it became very apparent to me that all that was an opinion. And they only had an opinion based on the inputs that were available to them. Of course, it was right in front of me. These guys, if they thought they should buy something, they did. If it went down, they were convinced it was heading in the right direction, so they'd buy more. That didn't make a lot of sense to me at the time.
Did you have influences, though? You said it didn't make a lot of sense to you. Was that you just deducing as a smart guy, or were you being influenced by readings or outside people, or was that just kind of you in the light bulb moment?
Well, a little bit of both, but wow, you're making me think from way back, because there was an article. Actually, I think it appeared in the Financial Analyst Journal, like way back, because I've thought about this recently. There was an article published in 1975 called "The Loser's Game," and that resonated with me very clearly because it was. And the simple example is playing a tennis match. There are sort of two games. There's the pro game where they make winning shots, and there's the game for everyone else. And most of us are just lucky to get it back over the net. But the sort of the point of that article was that's all you need to do is keep getting it over the net and wait for your opponent to hit it in and make a mistake. And if you do that over and over again, you can be a somewhat average tennis player, but you can turn it into a winning game. My boss at the time, who was the chartist, recommended I read this article early in my analyst career. And I just thought that made a ton of sense. And in fact, to this day, I apply it to my tennis game. But I also think it applies to my professional career as well. And that is, how do you become a professional and make winning shots? My career, my dad's advice was go corporate. So I did. I stayed corporate. He didn't think I should go into the brokerage world. And so I did that. But my career sort of took full circle later on.
Let me ask the big question, and we're gonna get to the current day, but I wanna infill some areas here. So we're going to talk about your firm's current strategy in a moment and perhaps some of the differentiation in that strategy. What's the first moment that you knew of the concept of trend following, deep in your bones, exactly what it was, all the details? When's that first moment, and how did that happen?
It didn't happen until much later. I had my career path took a few tangents. I ended up in working I went to business school, ended up working back in Winnipeg because I couldn't work in America, ended up being recruited for a firm out of Florida, the Ivy Funds. I was a senior guy at the Ivy Funds. And I was still dealing with these portfolio managers that thought they knew better. And in my view, they were either goats or geniuses depending on the year, but it wasn't anything to do with their actual process. And it wasn't until the writing was on the wall that the U.S. subsidiary that I was working at for the Ivy Funds, it was Ivy McKenzie, it was about to be sold. And I realized that I needed to sort of, rather than wait around for the sort of the whimsical corporate decision, I should look around. And I had the fantastic opportunity to go work for a guy named John Henry, who was based in Boca Raton, Florida at the time. And I was living and working in Boca Raton. It wasn't until then, because I actually I didn't have the exposure. I didn't know about it. And yet it all clicked. When I arrived at John Henry, I had done my homework. I was really excited about, trying to get in there.
Oh, you done your homework. What does that mean?
Well, yeah, that's a good question. I started checking John out, and it was actually really hard to find information about him in those days.
What year are we at? Early
2001.
Okay.
It was really interesting to me because I couldn't figure out. To this day, I would suggest that John is a difficult interview. Because most reporters will ask Mr. Henry and say, what's his view on the dollar? And to this day, he won't have a view. And that surprises everyone. They just don't understand it. They'll say, they preface their question with something like, Mr. Henry, you've made a lot of money as a commodity trading advisor. So what's your view on the oil market? John didn't have a view. And that really interested me. And it really, that was really refreshing in a sense because it was like, well, that's kind of interesting. How come? And when I started digging deeper to find out what his views were, that's when I thought, wow, this is sort of a breakthrough moment for me because I'd worked with all of these so-called professionals throughout my career. I had perhaps become a little bit cynical in respect to their abilities. And so from my perspective, going to work for one of the pioneers in the space like John Henry, this was a critical moment for me. I was fascinated and I guess I could say hooked.
Let me dig in a little bit more here. So you're prepping, you're going to go for this interview. I remember I've been to that office. Well, it's not there anymore, but was it Yamato Road, right? Right there in Boca Raton? Yeah.
You might not remember this, but I actually invited you to come.
But I'm actually thinking before that, with Mark there, I had got an appointment to go meet with Mary Beth Hardy.
Okay, that might have been, that might have been your first visit.
Yeah, this was really early. This was like mid-90s. And something happened and it didn't work out. But I remember going into that office for the first time. It was just a really interesting feel to be in Boca Raton because I had been in New York City, weeks earlier. And you go to Boca Raton and you're like, where am I going? You walk into like this office park, cool building. And then you see that big board up and you're like, okay, so why is he not on Wall Street? I don't get, it's all these questions start to happen. But for you, here you are, going in for this first interview. Talk about, you said you were doing all the homework about John. Were you connecting dots on the rest of his peers, for example, at that time?
No, I mean, it would have made a lot of sense had I been able to do that, but there was very little information. And I think that's where you've come in over the years because you've sort of filled that gap. Back then, I found it difficult to actually get information on what was going on in that world. It was much, much smaller then. While that's a logical, thing for me to have done, I remember it being very difficult. What I concentrated on, and this is somewhat of an ironic twist, I had, as we say up north, written the Series 3 exam, the Canadian equivalent. It's called the Canadian Futures exam. I wrote that when I was 22 years old for interest's sake, because like I said, I grew up in Winnipeg, commodity trading world. I was interested in the futures markets, and that stemmed from my oil options trading back in university. Come full circle, and I felt like I was somewhat prepared going into to my interviews at John Henry because I actually knew about futures, and I knew about the futures markets, but as I said, my career had sort of taken a bit of a detour in the meantime. And so for me, it was kind of familiar territory. I was sort of coming home. What I had not had the exposure to in all of candidness was the concept of trend following was new to me. And yet it connected the dots for me. That's the part that I know once I started, I really, it just was so refreshing. It was a very exciting time.
I would be amiss, and I want to jump into here in 1 minute or two on your current day and start to dig into some of the nuts and bolts of strategy for your firm right now. However, I would be amiss if I didn't ask a few questions or get a few pieces of insight from you where you can pass along to the audience, the people listening. You know, we're talking about your first employment with a trend following firm, and it just so happens to have been with a trend following legend. He's now turned into a baseball legend. You know, he's made several $1 billion for himself. Quite a successful man. I met him one time, but what could you pass along, even though he's a very quiet man, demure, what could you pass along to the audience where they could say, okay, that's really interesting. Maybe I learned something there. What can you give the audience, Ted?
You know, you're right about Mr. Henry. He is a mercurial kind of gentleman. He sticks to himself and has what I would describe as singular interests. Like, he's only got a few, and he's very deep in thought in respect to those interests. But I think some of the lessons that I learned working for him have resonated and sort of stuck with me to this day, and I think has led me in the direction that I've gone. And one of the things that John is really, really good about is and he would repeat this today, and I think it's sort of recorded in some of the work you've done and elsewhere, is that discipline is underrated. Discipline is a really key factor in what we do as traders, as investment managers. And I relate it to life. John's life is a very disciplined sort of organization. He runs his life systematically. And to some extent, I think I do too. I think maybe at sometimes my kids and my wife, I drive them a little nuts because I have systems to do things. And I apply that. I almost think philosophically, it's kind of like, do you make your bed in the morning and why? It's a certain sort of, I'm not a military guy, but I have a great deal of respect for the military guys. And there's a level of discipline in the military for a reason. It's repetitive. It matters. And I think that that's one of the key lessons that I acquired from working for somebody like, as you said, one of the industry legends.
One thing I was going to point out too, at least in my experience, and I think the Moneyball film did a pretty good job of this, at least in the kind of low-key personality. But there are so many, at the time when I was first investigating things, there were so many characters and big personalities. And look, you got a big personality in your voice. I know people might say that about me, but it'd be very different if John Henry was on this call. And I think for me, early on, that stuck with me. It was like, hold on, this is not about necessarily some outward presence to the world. This is an intellectual chess match. If you're good at that intellectual chess match, you don't have to necessarily have the dog and pony show. The dog and pony show helps to get customers in and people to know about you and all that kind of stuff. But if you're good and you can produce, the world seems to find you, huh?
I don't know if that's always true. I think there have been a number of there's been good talent. But
I just mean he was very shy.
He is very shy. And one of the smart things he did was, though, he surrounded himself, or he hired people that could complement his demeanor. And I think that's part of the talent. People don't realize, but he recognized that, and he hired people that could take the message to the market. And he hired people that did figure out that distribution had its value, and creating products so investors could access his strategies. And so I wouldn't want to underplay that, because I think that's an important factor, is that there's been you and I actually know some of these investors in the business. They're really good, but they haven't really made themselves accessible over the years.
Yep.
And so I think accessibility is a key factor, and I'm very conscious of that when I set out to build what we've done. I recognize that we can build it, but it doesn't mean that they're going to come. We have to allow them. It reminds me, Mike, of the old Monty Python sketch, The Cheese Shop. It's probably something you've forgotten over the years, but the guy, John Cleese, walks in and asks for cheese. And of course, there isn't any. And so you can build it, but you might be the finest cheese shop in all the land, but you've got to have product available to investors. And I think that's a key point for many, even some of the smaller CTAs and managed futures managers out there. A lot of those guys don't get that yet.
Well, just not to go off on tangents with other names, but I can think of a name in London who's probably the most respected trend following trader today and perhaps the highest earning, quite the character. And I think he did an exceptional job in the last 10 years of shaking hands and going out and talking and being a personality and explaining his world. And I think there's a tremendous number of lessons for everyone else in that from him.
Right, and that's a great example, in fact, because there's other examples out there that have done the opposite. So I really think that still is a part of it. And there's another piece to it in our business is that we are in, I don't know how to best characterize it, but I would still argue that we are not yet mainstream, that sort of our space is somewhat still an alternative one in a sense. I feel when I go to some of these industry events, it's a very collegiate atmosphere for the reason being we're all in this boat together. We all still have, I could talk to that gentleman you referenced in London, and he would talk to me because he knows where he came from, and he knows that we're in this boat. And I think you probably agree. I don't know, but
yeah, it's hard. I think it's hard for people to. This is such an interesting business. You can go from 0 to 60 really fast. You could go from being worth $1 million to $1 billion, sometimes very fast. It's really interesting in life to meet somebody that has done that trip, which, look, there's a certain bit of randomness to that, but to see them still be, to the extent they can be, when there's that many people that now want you, to see people still be normal when they hit such high marks. They still are regular people. I'm not saying all, quote, billionaires are regular people, but it is fun to see self-made entrepreneurs get there and, as you say, still be willing to talk and chat. It's nice.
Yeah, that's a great point. And the one thing is that it goes back to having a belief in what you do and why you've built it. And if you do have that belief, look, there are lots of different ways to invest money, and there are lots of different strategies. Some of them are better than others. And if you end up building your own, like we have, you end up having a very strong belief in what you're doing, or you wouldn't be doing it. I'm still fascinated because I actually think there are, of course, a number of different ways, and they're all valid in their own way or different timing, etc. I, as you said, it's an intellectual chess game. My partner and I are very engaged in that sort of way of thinking. I would put it, because when you're designing strategies, it really is about that. Like, what works and when doesn't it work, and how can you adjust? What do you build in to make it work is all a part of it.
Let's shift into that right now. Let's shift into strategy. But first, I want to read something from a piece of your work, a quote that you cite. I love this. It's from 1940. So somebody out there right now is already thinking, I'm going to turn this podcast off because Mike and Ted are going to talk about a quote from 1940. The quote is, "Human nature never changes. Therefore, the stock market never changes. Only the faces, the pockets, the suckers, and the manipulators, the wars, the disasters, and the technologies change. The market itself never changes. How can it? Human nature never changes, and human nature runs the market, not reason, not economics, and certainly not logic. It is our human emotions that drive the market, as they do on most other things on this planet." Jesse Livermore, 1940.
It's a classic, isn't it? I mean, it speaks volumes in so many ways. Today we apply a lot of the intellectual, labels like behavioral economics, right? Which I am also fascinated with, because I actually do believe that, markets behave like people. They can't help themselves. And concepts like self-fulfilling prophecies happen because people start making them happen. If people start talking about the markets going down, they start to go down because people start selling, and it just repeats itself. From my perspective, I subscribed early on to this repetitive nature in markets. And from my perspective, it made complete sense to profit from those directional moves. It just made sense. And so when I, heard, I'm certainly not the first one to coin this phrase, the trend is your friend, or follow the market, why fight it? When I first heard those phrases while I was working for John W. Henry and Company, it just absolutely was crystal clear to me. It made sense. And yet, I was, it dawned on me, but hey, there might be a different way of doing this. And over the years, I started to form my thinking, relative to that. But when I see a quote like this, it absolutely nails it on the head. Things don't, change in a sense. It just repeats itself. The trick is, how do you capture that repetition?
Ted, philosophy. I'm looking at your work here. Markets are inefficient and therefore trends materialize. Now, you say markets are inefficient. Eugene Fama says they are efficient, and he has a Nobel Prize. Don't you like me just putting you on the spot, huh?
Yeah. Well, am I going to win a prize for my answer? That's what I want to know. That's a great. I am on the spot, but I think the way we put it is, there are periods of time where there are inefficiencies, and so do they normalize at the end of the day? One could argue and win a Nobel Prize for yes. But our position is that there will be a period of time where there is dislocation. There is directional moves. The trends materialize because things are happening in the marketplace. You can't have that statement without the second qualifier. And it's the second qualifier to me that makes sense of that first part, is that it's all about directional moves. And so the question then becomes, if there are, the question is, why do those directional moves happen? If they were perfectly efficient, we'd just see it's nice, steady Eddie markets all the time. But that isn't what happens. And it goes back to the previous quote of Jesse and people and their behavior, embedded in markets. People don't behave rationally. The theory suggests they should, but they don't always. And so the question then becomes, how do you take advantage of those situations? And if you can do it profitably. And that's our perspective.
Ted, everybody wants to capture the trend, regardless of strategy. Everyone knows they want to capture Facebook from IPO to where it is today. That's a given. But here's what always stumps me is that if you just sit back and ponder for a moment and say, okay, I want to be able to capture Facebook from IPO to today. How do I do that? Now, what I don't get about the fundamental perspective is, how can anyone ever know all of the fundamentals? And if you can't know all of the fundamentals, doesn't it make sense to look at something simple like a price?
You definitely, absolutely, from our perspective, that makes complete sense. Your example is an interesting one. How can you know all about the fundamentals regarding a company like Facebook? I don't think the IPO and its reaction are based on the fundamentals per se. I would suggest or posit that there's a lot of emotion on the stock and the move and so on. Is the valuation even real? I don't know. And that was the first thing that sort of you grasp as a trend follower, is that if you don't know, then what do you know? From our perspective, the price at any given time is an aggregation of everybody's view in the market. Whether that's somebody is bearish or bullish, all those views are reflected in one factor, and that's price. And so from our perspective, and I would absolutely agree, you can't know all the fundamentals, and even then the fundamentals may not even make sense. So the only thing you can operate from is indeed price. And so that's absolute fundamental for us.
Let's talk about this for a moment, because I'm working on a new work right now, and I rethink how to describe the idea of just trading price. It really does take a light bulb moment to forget everything one has ever heard and just say, the price went from 5 to 7 to 8. I'm now going to buy it at 8 because I have an expectation that the price might continue.
That's a tough one. And that comes from experience and years being involved in markets. I agree. I think that's probably one of the reasons that more and more people don't jump into the business, because they haven't internalized that concept. You analyze the data and you analyze the markets and all the number of markets we trade, and over again, there is indeed repetition, and there are clear, definable, and recognizable moves, trends. And once you realize that, then trend following starts to make sense. But there's a key component that can't be left out. So much of what we do in the investment business, or what it happens in the investment business, I should say, is the focus on buying. There's very little focus on selling. Everybody wants to buy. And the traditional mindset is buy and hold. But what they don't tell you and they don't teach you is when to sell. And I think one of the really key aspects or components of what we do, the discipline that we've built into what we do, is that ability to sell. And we sell on an unemotional basis. We sell when the trend is over. Now, do we sell at the bottom or at the top or whatever, depending on what the direction of the trade? No, because we have no better crystal ball than anyone else. But we do know that the key aspect of trading as being a trend follower is that discipline of knowing when to sell. If you, to take your example for a moment, you know, it goes from 5, it goes to 7 and 8, and you get in at 8. If it goes back to 7 or maybe 6, you sell, you get out. As a trend follower, one of the fundamental sort of pieces to what we do is just to have that unemotional detachment, and your system says you're out. The fundamental guy would say, oh no, I know it's going up because I did my homework. And in fact, I'm going to buy more at 6. And they buy more of the dog that ends up going to 4. Whereas the trend follower protects capital because the trend follower will be out at 6.
People always seem to want to talk about or imagine the future. And then if you use an example of, like, let's say a past chart history, oh no, we can't talk about that. That's the past. Well, when we talk about the past from a trend following perspective, we're not trying to tell you it's necessarily going to be like the future. However, if one just observes charts and says, well, okay, here was an oil move that started in 2014. We didn't know where it was going to go in the middle of 2014. And then we look forward to early 2016. You can see this time and time again where there's just these huge moves. And if you're a person sitting out there that doesn't know how to trade these huge moves with fundamentals, my gosh, these simple ideas, the breakouts, the moving averages, of course, they can get a little more complicated depending on one's particular strategy. But there's very simple, robust type strategies that can get one into these big moves. And as long as you don't sit there, as you say, you're agnostic to the direction, as long as you don't sit there and question why the particular trend is going your way, as long as you're not concerned with why Facebook has gone to the moon and you're just happy to be on board making money, then it's an okay deal.
Yeah, absolutely. You know, it reminds me, not everyone has the sports almanac from from Back to the Future, right? We don't know how it's going to turn out, but I think it's that recognition, and it takes. It's counterintuitive in many ways. I think it's a maturation, because you know you've grown up when you can actually admit that you don't know what's going to happen. And in our space, and that I think it's common in our space, is that, you know, in trend followers in general, we're the first to admit that we don't have a crystal ball. We don't know what's really going to happen. And yet, over and over again, there are repeatable patterns, and those patterns, you know, we can track and profit from those patterns. The trick is, again, going back to and being a little repetitious, is just having the discipline to do that. To do that requires, as I say, sort of a maturation phase. You have to strip out the ego. You know, you might feel personally that, hey, this may be happening, but the system is saying, no, you know what, this is the direction. And having that ability to stick to what your discipline is, that's a key factor in, I believe, in being successful in this space.
I'm looking at a chart right now, or a table from your presentation. It says over 70 global futures markets traded on 15 exchanges around the world. I know your staff is not massive, but even if it was, I'm looking at these names, and I think back to when I first started to get a grasp on this myself, but I'm looking at, like, okay, gold, copper, other metals, maybe there's some relation there, sugar, orange juice, rubber, carbon emissions, the Hang Seng, the dollar index, 2-year notes, palladium, platinum. I mean, these things have nothing in common. And you, Ted, your partner, your firm, you guys are trading all of this. Now, I know how you're trading all of it, and I'm sure many of my audience does as well, but it's still quite amazing to be able to have a strategy that works on all of these different markets all around the world.
Well, it's amazing and exciting, because you're right. perhaps it's a bit misleading too, because it's very, very unlikely for us to have a position in all 70 of the markets that we trade. And so what a lot of people forget, they look at this and go, wow, you trade all 70 markets? And they automatically assume, because they're used to looking at lists. And so lists often are by definition, sort of all-inclusive, right? So they assume that we're invested in all at the same time. And it's not very, very unlikely in our case. The reason we trade 70 different markets that are completely unrelated is because we're looking for opportunity. We're trying to spot the markets that will be in a directional move. One of the aspects of our trading is that we look at the market as sort of a basket, and we apply the same amount static risk to each of the markets we trade. And we think of that risk that applied to each market as static, and it is for us, and we don't reassign that risk to another market. So we don't load up if we do get a directional signal to take a position. We might end up with a handful, maybe 10 to 25 of the different markets, depending on what's happening at any given day or week or month. We'll have positions in those markets. Those are the markets that are moving. And that's where, so we think of it as an opportunity recognition tool. The average investor wouldn't have a clue to invest in the Mexican peso, and I'd highly recommend they don't personally invest in a single currency market or a single agricultural market or any metals, energies, whatever. And yet, when you hire a professional manager like us, you get exposure to markets that you would never have any chance of having on an individual sort of personal basis. And we give the investor the opportunity to profit from markets that they wouldn't have that exposure to because we're tracking them. And that's sort of the value added from our perspective. And at the end of the day, as you well know, Mike, is that the net result is, and many of us are in this category, I think, of delivering non-correlated returns with pretty much everything else that a typical investor would hold. To us, that was sort of the genesis, or what the point of the strategy was to build something that could deliver non-correlated returns. Because we still believe strongly that there's great value in providing something different. And there's a number of examples over the years when investors were very pleased to have had exposure to non-correlated investment categories.
I want to get into how you have split your portfolio up in a moment between a typical, perhaps one could call it something different, but a typical trend following portfolio and individual equities. But one more point I'd like to make on that diversification that you just mentioned. It's really tough for so many people, I think. They want to imagine consistency, and that consistency also is about the market, meaning whatever market it might be. In their head, they think it is better, perhaps, to be consistent and make money in a particular market all the time. Whereas in your strategy, your profits, month to month, year to year, could come from markets that are entirely different every month, every year. That's different. That's different for people to accept, because many people, how'd you do on the S&P? Like, it's the only thing they're looking at. So if the S&P goes flat, they make no money. I mean, it's the buy and hold strategy, right? But I mean, it's really wacky almost that people will fixate on one market to the exclusion of all other opportunities.
Well, it reminds me of the old axiom, mother-in-law research, right? But I'm going to leave my mother-in-law out of it, and I'll just talk about my own mother. And she still calls me and says, Ted, I saw that the U.S. market is up, so you must be doing really well. or the complete reverse, she'll call me and say, Ted, I saw that the U.S. market was significantly down, so does that mean you're doing really well? And every time, like I've explained it to a few times, right? But she has that mindset where she sees the market as the market, right? And so I think that's a fairly commonly held concept, or that's what most people see it as and understand it as.
Trend following will always be alternative as long as that is understood to be true by most people.
Yes, I think that's exactly right. And therein lies the opportunity for those of us that continue to do it. It's interesting to me because, and that sort of goes back to your earlier question, but why do we trade so many markets? It's because we are trying, a lot of these markets, think of it as like a farmer. The fields, the markets will be in fallow, like they're sitting empty. They're doing nothing. or as we say in technical terms, they're neutral, or our position is neutral. But we think of it as having a position, even though we don't. We haven't reallocated that risk. The field is sitting there waiting for the next round. If that market starts to move either in a downward direction or an upward direction, we will then end up taking a position. And to us, it's just, keeping your powder dry so that when the opportunity hits, we can take advantage of it. At the same token, as I've mentioned, we are the first ones to automatically get out. And I think that is a philosophy that is shared by many of us in this space that is not well understood in what I would call the fundamental world. If you ask the average equity manager, of a long cap or large cap, large cap mutual fund, you'd say, well, so what are your stops? And I would suggest that the majority of those managers don't share the concept, and they don't think of it that way because they're basing their investment decisions on the fundamentals. Whereas for us, we don't have that ego invested in getting out. If we're wrong, we get out. And we take that small loss, the exact amount we were willing to risk on that particular trade. And so the way I like to explain it is in simple terms. And so perhaps this will help some of those that are listening, but we think of it as a P&L, like profit and loss statement. And about 60% of our trades, we lose money. And when you say that to the average investor or the average person at the cocktail party Friday night, they'll think, wow, they lose money 60% of the time? That sounds, like a crazy strategy. That doesn't make sense. How do they make money? And in our case, and I think you probably are following the bouncing ball, you know the answer. We know how much we're going to lose. And the easy math is if we lose $1 on 60 trades, we've lost $60. And yet, on those remaining 40 trades, our objective is to, it's again with easy math, to make $2 on those trades. So we gross 80, we net 20. Now that's not exactly accurate, but it gets the principle across of what we're trying to achieve. And we can do that because markets move. And that's that's why having a disciplined strategy is so critical in what we do.
You made the comparison to other types of managers, fundamental managers, that perhaps don't use stops or don't have a loss-taking criteria. Maybe this is a little bit strong for you. From my perspective, I look at the trend following philosophy and I say it equals responsibility. There's personal responsibility built into it, meaning there's not going to be a bailout for a trend following trader, etc. But I think that's the tough part, because these other types of strategies seem to be built on, and this is a tough word, a dishonest foundation, because they're only based on the idea that everything can go up. And clearly, the S&P can go down 50%, or the NASDAQ could go down 77%. So it's really interesting that so many people have their net worth, their net wealth, tied up in strategies, tied up in advisors that are seemingly not 100% honest about what they might know about the markets.
That's an incredible comment, Michael. I actually am with you completely on that, because that was a strong way of putting it. And I have a way of putting it. I call it the Morningstar paradox. And I'm amazed at some of these broker dealers that avoid alternatives because they think they're avoiding liability. I think the opposite is almost true. But the Morningstar paradox is my theory about how the Morningstar style boxes have locked investment managers into the style, and they have no room to maneuver. Even though their prospectus may give them, a great deal of maneuverability, they can't. Even if they get a message from above that the market is going down, and they personally may be going to T-bills, they remain fully invested. And they will continue to remain fully invested because that was what they were hired to do. And they don't dare run the risk of being accused of style drift and going to cash or anything else. They're stuck. And as an investor, you're stuck. And so the only way to get out is to sell the product. And then that actually ends up exacerbating the entire, the downward spiral. Again, creating opportunities for managers like ourselves.
But this looks great, though, to the average investor when you have, a bull market in stocks since March of 2009. Well, why worry? Hey, Ted, Mike, this is no big deal. Nothing could possibly happen. We have efficient markets.
that goes back to our original genesis. We saw, through the crisis, what happened? Well, real estate and equities tanked together. While positive correlation has positive connotations, it's not so good when you see both asset classes suffering badly at the same time. And what investors learned the hard way back in '08 was, while they thought they were sufficiently diversified, they weren't. It was a big hit. And for those that were smart enough to hold on, and they've recovered in this massive bull run that we've seen since. I would argue that it's been exacerbated slightly by our friends Janet and Mario, but that's a whole nother talk, perhaps. The fact is, what was very clear from that was there are different, or shall we say, alternative ways of managing money. In that period, the category as a whole did very, very well. For me, the genesis was, well, investors still don't have enough exposure. How could we do it differently? Because what we saw after that was we saw some of the managed futures guys and the CTAs not do so well. So there's sort of an ebb and flow to the category. And so what we built with very, specific intent was to build something a little bit different that would smooth out that cyclicality that has tended to exist in the managed future space.
Talk about that. So and I mentioned it a few minutes ago, we didn't get into it yet, which is the idea of taking a, quote, typical trend following type portfolio and then combining with it, or at least 50% of that portfolio being in individual equities. Talk about that idea, how that came, that hybrid, how that came to be, and perhaps talk about the individual equities part of it.
It goes back to my partner Todd's and my shared philosophy. And when we met each other, we came together here in Incline Village, where Ed Sakota was based. Todd's mentor was Ed Sakota, a name you know well. And Todd and I discovered pleasantly that we shared a great deal of similar philosophy and we outlook on markets in general. Post-crisis, we recognized that it did make sense for investors to have, in more diversification, and that they continued to have insufficient diversification. So we looked at a different way. And given the fact that we'd seen some cyclicality in the managed future space, we thought, how could we do this differently? And yet, we wanted to retain the benefits, the sort of what I would call the net benefit of managed futures, and that is that non-correlation. And to do that, we built what we call, our strategy is called the systematic hybrid. And it's a hybrid like the car. We have two, you could get technical, we call them alpha engines, or quantitative approaches, but two engines like the car. And the first is what we characterize as being somewhat traditional, classic, medium to long-term trend following across the 70 markets like we talked about. And the second engine is we've applied our futures experience and philosophy to trading an individual basket of equities. To us, that gave us more opportunity to profit from equities that were moving. So we're obviously, by definition, you can surmise we're trading high beta stocks or stocks with high relative strength, to put it another way. And applying that same philosophy. Stocks that are moving, to take your example again, that goes from 5 to 7 to 8, are going to go to 10 and then 12. And we try and identify those stocks and invest directly in those individual equities.
Going back in time, I can remember years and years ago, people would drop me a line and they'd say something like, well, trend following doesn't work for stocks. And now I'm talking to you, and you've got an interesting background being influenced by John Henry, your partner, an interesting background being influenced by Ed Sakota. And now you're telling me that trend following for stocks does work?
So we spent a couple of years trying to figure it out. And I will state up front, we have not found the utopian solution for shorting the individual names. Very, very challenging on a number of levels. The stock selection process, the timing of the short, the sizing of the shorts, and on a number of levels. To apply managed futures trading philosophy to shorting individual names, very difficult. And we have not found that, what I call that utopian solution.
That is something that I've heard very typically over the years, where you can have the agnostic direction, long or short, on the futures side. But on the equities side, it has been pretty typical to have a long-only bias. But the key thing being, if you have a long-only bias on equities, you still have a stop, which is quite different than everyone else.
And we take it a step further. You're right. So the part that we could apply to our equity trading is we have a stop on every single equity trade. We took it a step further, and this is where we think it really adds value, and ultimately we think could provide some downside protection to investors ultimately in this engine of our portfolio. We took our experience and expertise on the managed future side, and we've taken a stock index futures overlay. We like to call it internally, we call it the hedge. We will short the index. If there are signals coming to us that the stock market in general, the U.S. domestic market is starting to drift down, the signal will come to the system and we will initiate a short position on the market as a whole. We may still have long exposure in some of those high beta names. As those high beta names either get stopped or kicked out, depending on the criteria, eventually our equity engine could end up being in a net neutral position. As those equity individual names get kicked out or stopped out completely, that short will remain in place and will actually end up being net short on the equity engine. That's going to be very, very critical for us if and when the equity markets do start to soften up. By design, we are still able to go long or short. We just do it a little bit differently. And we think it's a much more prudent approach than most long-short equity funds have, which tend to have a net long bias anyway.
It's an interesting conundrum because I know in 2008, many trend following traders trading stock indices did exceptionally well. So it's a tricky thing. I think most people would probably agree that stocks have a bias to the upside, a bull bias. And I guess that's not surprising when you think about the typical mindset of most people. But when those down periods happen, boy, they can be sharp and they can be extended. And as I say to people, I seriously doubt the Japanese believe in buy and hold anymore.
That's great. That's we've seen the evidence. I've been around, as we covered earlier on, and my career goes back to the mid 80s, and I'm a student from before then. So I feel like I've seen quite a lot in my career. We know it can happen, and we've seen it, and as most recently as 2008, and here we are now in a full bull run. For us, our equity portfolio has been had a net long bias over this last period of time, and we've done, on a relative basis, we've done very well because of that. We feel good because we built something that works in the good times, but we have a very defensive mechanism built into the strategy that if it gets tough on us, we still stand a very good chance of doing well in tough times as well.
Ted, we're going to send people to Incline Investment Management. Your website is inclineim.com, correct?
It is.
I appreciate you talking today. Good stuff. I think people are going to enjoy this. I think we really kind of gave people a broad philosophical perspective and some details and maybe some strategy differentiations from your perspective. I think they can find a lot more information if they want to check you out, reach out to you again, inclineim.com.
Michael, thank you very much for the opportunity. I really appreciate being a part of what you do.
Thanks, sir. I appreciate it. Good conversation.
Thank you.
I see a time when those awake will understand how to make money in up, down, and surprise markets. Whether new trader or experienced, college student or financial advisor, protecting against a crash, or just trying to make a lot of money, trend following offers everyone an answer in uncertain times. To get started immediately, send me an email, michael@covel.com. I will send you the right trend following steps to take along with my free video. But if you want to buy and hold, trust the government and trust Wall Street, this is absolutely not for you.